Well, thanks so much for the invitation to present our work on shareholder activism and firms' voluntary disclosure of climate change risks. This is joint work with Mike Toffel and Kala Viswanathan from Harvard. As you know, companies increasingly face pressure from their very own investors about disclosing their exposure to climate change risks. And so this you can see in several headlines here. I'm just clicking through these. And, more generally, investors are increasingly interested and concerned about their company's exposure to climate change risks and accordingly also their own exposure to climate change risks. And so they make increasing pressure on their portfolio companies to disclose their exposure to climate change risks. And perhaps the most striking evidence is provided by a recent survey of more than 400 institutional investors that finds that the majority of respondents believe that climate risk reporting is as important as financial reporting, and actually 1/3 of them believe that climate risk reporting is even more important than financial reporting. Now, this leads me to this research, to the research question here. Despite shareholder activism being on the rise in terms of forcing or pressuring their portfolio companies to disclose their exposure to climate change risks, it's actually, we know very little about whether this tactic is actually effective in triggering de facto greater disclosure. And if so, if it does trigger greater disclosure, what type of shareholders are most effective, and does it actually improve firm value of those companies that disclose climate change risks? Okay, so this is the focus of our research study here. Now, before I continue, let me just take a step back and highlight kind of the broader context in which companies face themselves in. So companies face increasing risks with respect to climate change. So this includes an increase in energy demand, the damage of coastal property and infrastructure, disruption in supply chains and operations, etc., etc. Secondly, companies also face increasing regulatory risks where increasingly government do take actions to curb climate change, and probably one of the prime examples is the Paris Agreement from 2015, where 195 nations agreed to limit global warming to below 2 degrees Celsius. And in fact, even the sight of strict environmental regulation can send a strong signal to investors of carbon-intensive companies. Third, companies also face increasing pressure from social activist groups, pressuring their companies to address environmental and social issues, and this pressure has intensified with the use of social media. And so perhaps as a result of these different trends, investors are increasingly on their toes and want to know about the exposure of their companies to climate change risks, and so the question then is, should they take actions? And if they do take actions, are they effective? And what we need to know, again, as a background, is that in most countries around the world, including the US, there's a lack of mandatory disclosure requirements in terms of disclosing the company's exposure to climate change risks and non-financial information more generally. Okay, so as a case in point, for example, the US SEC, they merely recommend the companies disclose their climate change risks, but they don't mandate it, nor do they offer any guidance on how to disclose it if they were to voluntarily disclose these risks. Now, there was a recent development at the SEC where they considered to mandate the disclosure of climate change risks, but this pretty much came to a halt for now. And so de facto, at the end of the day, in most countries around the world, companies are not forced to disclose their exposure to climate change risks. And as a result, they fail to disclose those risks. Now, why is this actually a governance issue? So why would we care? Why would investors care? Well, let's look at the potential benefits and downsides of disclosing these climate change risks for the disclosing company. Okay, on one hand, disclosing these risks may help firms to manage and mitigate these risks in the long term. For example, increased transparency can increase firms' accountability in public's eyes, which helps strengthen the firm's commitment to manage and mitigate these risks moving forward. We also know that transparency allows investors, business partners, and other stakeholders to engage in a more informed manner with the disclosing company, and so they may also be able to offer more effective advice in how to manage and mitigate these risks moving forward. And last but not least, transparency helps foster trust, which also helps strengthen the firm's relationship with its various stakeholders. Now, while there are benefits that may come with the disclosure of climate change risks, the tricky part is that these benefits are likely only going to kick in the long term. While in the short term, companies may face downsides of actually disclose their exposure to climate change risks. And this includes, for example, revealing potential vulnerabilities that the firms would prefer to keep away from investors, competitors, and customers. Think about, for example, the disclosure of stranded assets. Secondly, disclosing climate risk information entails direct costs to the disclosing company because they need to actually have a human being to track, measure, track, and disclose these risks. And lastly, the disclosure of climate change risks may result in adverse reactions by the company's various stakeholders, which may exacerbate the risk exposure of these companies. And so the bottom line is that management has an incentive not to disclose climate risks unless it's mandatory. And this reluctance to disclose climate risk exposure is accentuated by managerial myopia. And let me just give you a little bit more background here. From a large literature in psychology and economics, we know that individuals in general, so not just managers, but individuals, human beings in general, also called hyperbolic discounters, meaning we have a preference for the short term. So in other words, we might prefer short-term rewards over long-term rewards, even if long-term rewards are substantially higher. And this myopic behavior, reasons for this may include cognitive limitations, instant gratification, impatience, etc. Now, for managers, this myopic behavior might be further reinforced by career concerns. If you fear you're gonna be fired any minute, if you underperform, you're gonna focus even more on the short term than you would otherwise naturally do. In addition, analyst pressure to meet or beat analyst earnings expectations can further reinforce this myopic behavior. And then, of course, short-term compensation may also add on to that. Okay, so as a result, myopic managers tend to favor short-term investments over long-term investments, even if long-term investments would provide long-term firm value. And so we call this a time-based agency conflict, where managers' interests and preference are misaligned with the owners of the company due to a different temporal perspective. Now, what are the implications of this time-based agency conflict for the voluntary disclosure of climate risks? Well, the implications are that on one hand, managers may put more weight on the potential short-term downsides of disclosing their climate change risk exposure, as opposed to the potential benefits that would kick in the longer term. And second of all, due to this myopic behavior, managers might focus more on stakeholders that have short-term financial implications for the firm, as opposed to stakeholders that might very much be available to the firm in the long term, but they're less salient, and therefore managers might actually ignore them in the short term. Okay, so in sum, in absence of public governance, in absence of mandatory disclosure requirements, firms often fail to disclose their exposure to climate change risks and adapt and mitigate these risks. Okay, and a recent study by Shali from the London Business Schools confirms this, that indeed many companies not only fail to disclose their climate change risks, but actually fail to adapt their business strategies to physical climate risk exposure. And in fact, she finds that only about 23% of companies adapt in some way their business strategies to increase exposure to climate change risks. And if they do, those that do, they only adapt in an artificial way, in a superficial way, but they don't necessarily fundamentally adapt their business strategies. Okay, so this raises enormous red flags here. And so this then raises the question, can shareholders do something to help improve the governance of the company? So in other words, in absence of public governance, can private governance in the form of shareholder activism elicit greater disclosure of firms' exposure to climate change risks and how they manage those risks? And if so, who are the shareholders that would be most effective, that would be in the best position to do so? And what are the value implications of the disclosing company? Does it hurt the company financially if they were to disclose these risks? Okay, so this is precisely the focus of our study. And so to answer this question, we use data from the Carbon Disclosure Project and the Institutional Shareholder Services database. We merge these data, obtain a final sample of 1,110 firm year observations, and our sample period is 7 years from 2010 to 2016. And what we find, so I'm going to skip all the data methodology, etc., and let me just go straight to the point. Our key findings are that, yes, shareholder activism can induce management to voluntarily disclose climate change risks. And this shareholder pressure is particularly effective if it's initiated by long-term institutional investors. And when we look at the valuation implications of disclosure following the shareholder activism, we find that firms that voluntarily disclose climate change risks experience a stock price increase by around 0.9 to 1.2% following the shareholder activism. Okay, so in other words, active shareholders can indeed elicit greater climate risk disclosure and hereby improve the governance of the portfolio company, meaning it also helps improve firm value in the long term. Now, having said this, before I get to the having said this, what it means for practice is that in absence of mandatory disclosure requirements, this greater ability also implies greater responsibility of investors, and especially of long-term institutional investors, to be active owners and to actively engage with the portfolio companies to elicit greater climate risk disclosure. Now, what I do want to caution is that by no means are we saying that private governance is the most effective way to deal with this issue, correct? So while private governance in form of shareholder activism can indeed trigger the portfolio companies to improve their disclosure of climate change risk exposure, it is unlikely substitute for public governance, because public governance would likely be more effective in improving the quantity and quality of disclosure, in fostering standardization of disclosure, and in ultimately achieving progress in the fight against climate change. So, and these are my concluding words here, long-term institutional investors may find it worthwhile to not only actively engage with the portfolio companies to increase the risk disclosure, but also at the same time to engage with public policy to impose mandatory climate change risk disclosure. Thank you.